They told you to never put all your eggs in one basket. But here's the thing, the rich don't even own baskets. They build the damn chicken farm. That line alone probably made some financial advisor somewhere choke on his morning coffee, but let's be honest, it's true. Most of us were raised on this gospel of diversification like it was the 10th commandment of money. Don't risk too much, spread it out, be safe. But what if I told you that the same rule that's supposed to protect you might actually be keeping you broke? Let me tell you about my friend, Jake. Jake's a good guy. Smart, careful, spreadsheet kind of person. He'd been saving up for years and finally decided to start investing like the pros. So he opens his brokerage account, watches a few YouTube videos, and proudly announces, "I'm diversifying." He buys a little bit of everything, some tech stocks, a bit of real estate ETF, a sprinkle of crypto, a few dividend funds, and even a slice of gold, just in case the world ends. 6 months later, I ask how it's going. He sighs and says, "I've got a little bit of everything and a lot of nothing. That's diversification in action. You own the whole buffet, but somehow you're still hungry. You're not losing, but you're definitely not winning." Here's the uncomfortable truth. Diversification might protect you from disaster, but it also protects you from greatness. It's like wearing a helmet and knee pads to bed. You're super safe, but you're not exactly living your best life. Now don't get me wrong, I get why people do it. The world feels risky. The markets are unpredictable. The idea of losing everything terrifies us. But the rich, the people who actually build wealth from scratch, they don't play defense, they play offense. They pick one thing, commit like crazy, and pour everything they have into it. And that's what this audiobook is about. Unlearning the lie of diversification and understanding how the wealthy actually think about focus, risk, and conviction. By the way, if you're enjoying this kind of financial myth-busting, go ahead and follow the show. I promise it's more profitable than your last index fund. All right, ready? Let's go back to where this whole idea began, the birth of diversification itself. The origin of diversification. Let's roll the clock back to the 1950s. Picture a guy named Harry Markowitz, young, brilliant, the kind of person who probably had more pencils than friends. Harry was a math whiz, the kind of guy who could look at a pile of numbers and see something mystical in them. One day, he had an idea that would change the way Wall Street talked about risk forever. His theory, which he called modern portfolio theory, or MPT, because even geniuses know acronyms sound cooler, basically said this: if you mix a bunch of different investments together, you can lower your risk without totally killing your returns. In simple terms, Harry was saying, you can eat your cake and not get a stomachache. It was brilliant for its time. Remember, this was an era when most investors were just guessing. There was no internet, no online trading, no meme stocks. People bought shares because their barber said, "I hear steel's doing well." So Harry's math made him look like a prophet. He even won a Nobel Prize for it. But here's where things got interesting, and a little bit twisted. Wall Street heard this beautiful theory about reducing risk and thought, wait a minute, if we tell everyone to diversify, that means they'll buy more products. And if they buy more products, we make more money. So the idea spread like wildfire. Suddenly every financial advisor, every investment firm, every mutual fund manager was singing the same song, diversify, don't put your eggs in one basket. And it makes sense for them. Think about it, if your money is scattered across 20 different funds, guess who's getting a slice of every one of those pies? Not you. The banks, the brokers, and the middlemen. They turned Harry's math into marketing. Now, I'm not saying diversification doesn't work at all. It does, in a very specific way. It helps people who already have a fortune keep it from evaporating. But for the average person trying to build wealth, diversification is like eating at a buffet. You walk in excited and you want to try everything. A little pasta, some sushi, a bit of salad because you're pretending to be healthy, and then 3 desserts because, well, you earned it. But what happens? You leave stuffed, unsatisfied, and slightly ashamed because none of it was actually great. That's diversification. A little bit of everything, but never enough of the good stuff to make a real difference. See, when you spread your money too thin, you're not investing anymore. You're sampling. You're nibbling at opportunity without ever committing to a real meal. And that's how most portfolios end up. Perfectly balanced, perfectly dull, and perfectly average. Meanwhile, the people who make headlines, the ones who go from nothing to something, they didn't build wealth by spreading themselves across 30 different stocks. They went deep on one idea, one business, one industry. Harry Markowitz gave Wall Street a tool for managing fear, but the system turned it into a way to keep you comfortably mediocre. And the irony? Even Markowitz himself once admitted that he didn't fully follow his own model. He said something like, "I should have known better, but I just split my money 50-50 between stocks and bonds." The father of diversification winged it. So yeah, diversification started as a math experiment about managing risk, but it evolved into a religion, one that benefits the preachers more than the believers. In the next chapter, we'll peek over the fence and see how the rich actually play this game, because, spoiler alert, they don't pray to the god of diversification. They play by an entirely different set of rules. How the wealthy actually invest. Let's talk about how the rich really do it, because, spoiler alert, they're not out there buying a little bit of everything. They're not sitting on a couch saying, "I think I'll spread my money evenly between tech, bonds, and small-cap mutual funds." No, the wealthy don't play that game. They pick one thing, go all in, and double down until it works. Take Elon Musk. The guy didn't start SpaceX, Tesla, and Neuralink all at once. He sold his first company, PayPal, and poured nearly all the money, I mean almost everything, into building rockets and electric cars. Rockets and cars. Two of the hardest, most expensive, most failure-prone industries in the world. Any normal person would have said, "Maybe I'll diversify a little." Elon said, "Nah, let's bet it all on Mars." Then there's Jeff Bezos. When he started Amazon, he wasn't selling every product under the sun. It was books, just books. He was obsessed with making it the biggest bookstore in the world. People thought he was nuts. He quit a cushy Wall Street job, moved to Seattle, and built a company out of a garage. But that laser focus turned into something massive. Only after Amazon became unstoppable did Bezos start diversifying into cloud computing, groceries, streaming, and even space travel. And Oprah, let's not forget her. Before she became a billionaire media mogul, she focused everything on her talk show. She owned it, controlled it, and poured her energy into it for decades. When everyone else was spreading out, Oprah was digging in. That one platform became her empire's foundation. The pattern's obvious once you see it. The rich don't spread their bets, they stack them in one place until the table tilts in their favor. It's conviction over comfort, courage over caution. Imagine a poker table. The average player is constantly folding, checking, or playing tiny hands just to stay in the game. They're scared of losing their chips. But the great players? They wait, they watch, and when they see the right hand, they push all their chips to the center and say, "I'm in." That's how the wealthy think. The rich play to win. The rest of us play not to lose. They don't call it risk-taking, they call it focus capital. Instead of diversifying dollars, they diversify effort, talent, and people. They know that putting all your money into one thing might be risky, but putting all your energy into a dozen different half-baked ideas is a guaranteed way to stay average. Think of it this way. Money behaves like light. When it's scattered, it illuminates a room, but when it's concentrated, like a laser, it cuts through steel. That's what focus capital does. It builds empires. Look at any self-made millionaire. Almost all of them have one story in common. They went all in on one skill, one business, one industry. Then, and only then, did they expand. Warren Buffett didn't start with 50 companies. He started by mastering value investing. Sam Walton built Walmart one store at a time. Even your favorite YouTuber or startup founder, same thing. They went deep before they went wide. Here's the mini hook I want you to remember. The rich don't diversify their money. They diversify their time. Big difference. They'll invest years mastering one thing, learning every inch of the game, and once they've won, that's when they branch out. That's when diversification makes sense. As protection for what they've already built, not as a substitute for focus. So next time you hear someone say, "Don't put all your eggs in one basket," remember, the people at the top didn't just pick a basket. They built the whole farm, raised the chickens, and started selling the eggs. In the next chapter, we'll talk about why most people can't bring themselves to do that, the psychology behind playing it safe, and why fear makes us cling to the idea of diversification like it's a life raft in calm water. The psychology of playing it safe. Let's get honest for a second. The reason most people diversify isn't because they've studied Harry Markowitz or modern portfolio theory. It's because they're scared. Plain and simple. Fear drives more financial decisions than logic ever has. We spread our money around not because we're being strategic, but because we're trying to make that uncomfortable little voice in our head quiet down. The one whispering, "What if you lose it all?" I've seen it 100 times. Take my friend Lisa, for example. She got into crypto a while back. Peak hype. Everyone talking about it at every dinner table. Instead of picking one solid project, she goes, "I don't know which one will win, so I'll just buy a little bit of everything, just in case." So she buys 12 different coins, $10 each. $120 total. She was so proud. "I'm diversified," she said. Fast forward 6 months and every single one of those coins had tanked. Every single one. The best part? If she had just gone all in on one of them, even randomly, she would have made something. But by trying to avoid losing, she guaranteed mediocrity. That's what fear does. It doesn't protect you, it paralyzes you. And it's not just Lisa, it's most people. We're raised to play it safe. Save your money. Keep your head down. Don't take too many risks. Society has a way of making safe sound responsible, but in reality, it's just dressed up fear. Diversification, for most people, isn't a wealth strategy. It's a security blanket. It feels warm and responsible. You can tell yourself, "I'm being smart," when really, you're just avoiding discomfort. You're spreading your fear thin instead of facing it head on. But here's something to chew on. Courage pays compound interest. Every time you make a bold move, even a small one, you grow a little. You get smarter, sharper, stronger. And over time, that compounds. Playing it safe doesn't. It just keeps you where you are, wrapped up in that cozy blanket of what-ifs. I get it, though. Fear is natural. It's wired into us. Back in the caveman days, fear kept us alive. Don't go near the tiger, don't eat that weird berry, don't sleep in the dark cave with glowing eyes in it. That kind of fear made sense. But in modern life, fear just stops us from doing anything remarkable. We're not facing tigers anymore, just tough choices. And when we let fear run the show, it convinces us to spread instead of build, to dabble instead of dedicate. Here's the thing. Safety doesn't create success. Conviction does. Every great builder, entrepreneur, or investor has one thing in common. They were willing to be uncomfortable. They leaned into fear, not away from it. So if you've ever felt scared to commit to one thing, just remember this, that fear you feel isn't a stop sign. It's a green light that says, you're heading towards something real. Diversification is the adult version of hiding under the bed. It feels safe, but it's not where the magic happens. Focus builds wealth. Let's talk about focus, that rare, almost old-fashioned word that built every fortune you can think of. Because while most people are busy spreading their bets, the ones who actually win are the ones who concentrate their energy, their money, and their time on one clear goal until it pays off. There's a local business owner I know. Let's call him Marco. Marco ran a small cafe in a downtown neighborhood. It wasn't fancy, just a coffee shop with some pastries and a loyal crowd. After a few years, he got bored. He wanted to grow, but he wasn't sure how. So he decided to diversify. He started selling juice, then smoothies, then a line of protein shakes. Before long, his cafe looked like a confused breakfast buffet. He was doing 10 things halfway instead of one thing brilliantly. Sales dipped, stress climbed, and he almost closed down. Then one day, over a cup of his own coffee, he realized the obvious. People weren't coming for the juice, or the shakes, or the half-hearted food. They came for the coffee. His coffee was incredible. It was his craft, his passion, his one thing, so he scrapped the extras, doubled down on what worked, and focused entirely on coffee. Better beans, better roasting, better branding. Within a year, the cafe was thriving again. Within 3 years, he opened 2 more locations. And today, he supplies coffee beans to other shops across the state. Focus built his wealth. Diversification almost destroyed it. See, energy is like sunlight. When it's scattered, it warms your face. But when you focus it through a magnifying glass, it burns through steel. That's the power of concentration. The rich understand this instinctively. They don't chase 10 ideas halfway. They chase one idea all the way to the finish line. And once they win, then they diversify. That's the natural order of wealth creation. Build, grow, protect. But most people do it backwards. They try to protect, build, grow. They want to feel safe before they take a risk. But safety comes after success, not before it. Look at how entrepreneurs operate. They start by building. That's the all-in phase. Sleepless nights, every dollar reinvested, every risk taken. Then they grow, scaling what works, optimizing, expanding. And then comes diversification, spreading out the profits to protect what they've built. But the average investor skips the build and grow part entirely. They start by protecting money they haven't even made yet. They play defense before they've even touched the ball. It's like trying to buy car insurance before you've bought a car. The system teaches us to protect imaginary wealth instead of focusing on creating real wealth first. When you go deep into something, your business, your skill, your craft, the risk might feel high, but your control is also higher. You understand every part of what you're building. You're not at the mercy of market swings or headlines. You're in charge. That's what focus gives you, power and clarity. And when you finally reach that point where what you've built is strong, that's when diversification makes sense. That's when you start spreading your wings, investing in other projects, creating layers of safety. The rich diversify after they win the game. Everyone else diversifies before even learning the rules. So if you're in that stage of building right now, maybe you're starting a business, developing a skill, or betting on your dream, remember this: focus is your greatest multiplier. Every distraction you remove, every maybe you eliminate, sharpens that magnifying glass and amplifies your fire. Build first, grow it, protect it later. That's how wealth is really made. And speaking of myths, in the next chapter we'll expose a few of the biggest ones, the half-truths and catchy phrases that have been keeping people financially stuck for decades. Because some of the rules you've been taught about money, they're not rules at all, they're sales pitches. Myths that keep you poor. Diversification is how the financial industry sells fear, one fund at a time. Let's talk about the myths that keep people broke, because for all the fancy terms and complicated charts, most of what passes for financial wisdom today is just recycled fear, wrapped in confidence, and sold with a fee. Myth number 1, more investments mean less risk. This one sounds logical, right? Spread your money around and you won't lose it all. But here's the problem. If you own a little piece of everything, you're exposed to everything. When the market drops, it doesn't care that you're diversified. Most things go down together anyway. It's like thinking you're safe from rain because you're standing under 5 leaky umbrellas instead of 1. Having more investments doesn't mean you've reduced risk. It usually just means you've multiplied confusion. You're not managing wealth, you're managing chaos. And that chaos is great for one group of people, the ones charging you fees for each of those investments. Now, myth number 2, you need multiple income streams to be safe. This one gets tossed around on social media like gospel. The average millionaire has 7 income streams, they say. Sure, but nobody tells you when they got those streams. Most of them built one successful business or career first and then branched out. Meanwhile, people hear that line and go nuts. Suddenly they're flipping houses, day trading, selling candles on Etsy, running a YouTube channel, doing affiliate marketing, and writing an ebook about all of it. They call it multiple streams, but it's really just a flood of exhaustion. We all know that guy on YouTube who brags about having 5 passive income streams, and then you realize every single one of them takes 40 hours a week to manage. Nothing passive about it. It's just active chaos in a hoodie. The truth is, you don't need multiple income streams to get rich. You need one income stream that actually works. One you control, one you can scale, one you can master. Build that first, then diversify. You don't open 7 restaurants at once. You build one that people love and then replicate it. And now, myth number 3. Passive investing is for everyone. This one's tricky because it sounds so safe, so easy. Just put your money in an index fund and forget about it. And yes, for some people it works fine. But here's the truth nobody tells you. It's not a wealth-building strategy. It's a wealth-preserving one. If you already have a pile of money, sure, toss it into the market and let compounding do its thing. But if you're still building your wealth, set it and forget. It is basically financial sedation. You're taking your hands off the wheel before you've even started the engine. Passive investing was invented for people who don't want to think about money. And guess who profits from that? The institutions that take a cut of every passive move you make. So, to recap, more investments don't equal less risk. Multiple income streams don't equal security. And passive investing doesn't automatically make you wealthy. These myths sound smart, they sound safe, but they all come from the same place: fear. Fear of losing, fear of failing, fear of missing out. And the system loves that fear because it keeps people compliant, cautious, and average. But the truth? The people who break out of average never do it by following fear. They do it by following focus, strategic focus. How to go all in wisely. All in doesn't mean all crazy, it means all committed. That's the biggest misunderstanding about going all in. People hear focus and immediately picture someone emptying their savings account into a single stock, quitting their job on a whim, or starting a business with no plan. That's not focus. That's a daredevil move with a blindfold on. Real focus is strategic. It's built on 3 pillars: research, conviction, and control. Research means you understand what you're betting on. You've done the homework, not just scrolled through Reddit threads and TikTok videos. You've read the boring reports, looked at the numbers, talked to people in the field, and figured out what you're truly getting into. Conviction means you actually believe in it, not because someone told you it's the next big thing, but because it makes sense to you. You've thought about it so deeply that the idea lives in your bones. You could explain it to a stranger at a bus stop without blinking. And control, that's the one most people forget. You should only go all in on something you have at least some control over. Your own business, your skill, your creativity, your product, your decisions. The more control you have, the less risky the risk becomes. Here's an example. Imagine a woman named Dana. She's been working as a software developer for years, but her real passion is creating digital tools for small businesses. For a while, she dabbled. A little freelancing here, a side project there. Nothing serious. She told herself she was diversifying her skills. Then one day she looked at all the things she was doing and realized none of them were moving her forward. So she made a decision. She quit her side hustles and focused entirely on building one software product, an app for small retail stores to manage online orders easily. She spent a year building it, learning the ins and outs, talking to customers, tweaking features. Her friends thought she was crazy for putting all her energy into one project. But Dana wasn't guessing. She had done the research, built conviction, and kept control. Within 2 years, that app became her full-time business. 5 years later, she sold it for a few $1,000,000. That's not luck, that's strategic focus. The secret to going all in wisely is something called asymmetric betting, where the downside is limited, but the upside is massive. You find situations where the worst-case scenario is manageable. Maybe you lose some time or a modest amount of money, but the best-case scenario changes your life. Most people flip that equation. They take small upsides with big downsides, investing in things they don't understand, chasing trends, or spreading thin to reduce risk. Strategic focus flips it back. Here's the test. Before going all in, ask yourself 3 questions. 1. Do I understand this deeply? 2. Do I believe in it enough to stay committed when it gets hard? And 3. Do I have at least some control over the outcome? If the answer to all 3 is yes, then it's not a gamble. It's a calculated bet. Focus doesn't mean recklessness. It means clarity. It means saying no to 99 things so you can say yes to one thing that matters. So don't be reckless. Be relentlessly focused. Because when your energy, your time, and your resources all point in the same direction, you don't need luck. You just need momentum. And speaking of timing, in the next chapter we'll talk about when diversification does make sense, because once you've built something worth protecting, spreading out finally has a purpose. When to diversify. You diversify your wealth, not your dreams. That's the key difference between how the wealthy diversify and how most people do it. The timing is everything. You don't diversify on the way to success. You diversify after you've built something worth protecting. Diversification, when done right, isn't about growth. It's about protection. It's your armor, not your sword. Think about entrepreneurs who hit it big. They go all in on their business, grind through years of risk and focus, and finally hit that jackpot moment, a buyout, a successful IPO, or a massive profit. That's when diversification steps in. Take someone like Sarah Blakely, the founder of Spanx. She went all in on one idea, shapewear that actually worked. She wasn't dabbling in 10 different fashion ideas at once. She focused, built an empire, and once she sold a large stake in her company, then she diversified, investing in other startups, real estate, philanthropy. Same thing with most tech founders. They build one company, sell it, and only afterward do they start spreading their capital into different ventures. They go from builder to investor. That's the right order. It's the build, grow, protect model again. You build something of value. You grow it until it becomes stable. Then you protect it through smart diversification, spreading your wealth so no single failure can take you down. Most people reverse that. They try to protect wealth they haven't built yet. But you can't protect potential, you can only protect results. So when should you diversify? When you've won your first game. When your main thing, your business, your skill, your career, is solid enough to run without your constant attention. That's when you take your chips off the table and place smaller bets elsewhere. Diversification after success makes you safer. Diversification before success just slows you down. And that famous saying, "Don't put all your eggs in one basket," it's been quoted to death, but the version people forget is what Mark Twain actually said next. Put all your eggs in one basket and watch that basket like a hawk. That's the mindset. Total focus until the basket is overflowing, and then you buy a few more baskets. So yes, diversification has its place, but it's the final stage of wealth, not the first. The real lie. Here's the real lie of diversification. It feels safe, but it kills conviction. It convinces you that spreading thin is smart, that balance equals progress, and that playing defense is the same thing as winning. But safety and success don't live in the same house. The truth is, wealth isn't built by people who tiptoe around opportunity. It's built by people who commit, who pick something, own it, and go all in until it works. Diversification has its place, sure, but not at the start. In the beginning, it's focus that creates momentum, and momentum that creates freedom. So stop thinking like a fund manager and start thinking like a founder. A fund manager's job is to not lose money. A founder's job is to create something new. Those are two completely different missions. You don't build empires by managing risk. You build them by managing purpose. Let me leave you with this image. A lion doesn't chase every gazelle it sees. It studies the herd, locks eyes on one target, and goes full speed. It doesn't diversify its energy. It focuses, and that focus is what fills its belly. Your dreams deserve the same kind of focus. Pick your gazelle and run like your life depends on it. If this episode challenged what you've been told about money, hit follow or subscribe, because we're just getting started tearing down financial fairy tales. Focus, build, win, then diversify.